Welcome to our 2014 investment review. We made a decision to present this to you as a video this year for a number of reasons. Firstly, we believe this provides the time for you to review this video ahead of our meeting and to come to our meeting with any questions or thoughts that you may have on the topics that we've discussed. Secondly, we believe this is going to provide the facility for you to go back and review the contents of this video later in the year, not have to rely on memory of what I said during the course of the meeting. But thirdly, and most importantly, doing it this way means that we can spend time on the things that are important to you during our meeting, as opposed to just going through the presentation. And we trust that you're going to enjoy this video. We look forward to hearing your feedback on it. So let's have a look at the next slide, and in it we're going to have a look at our agenda for this video, have a look at the things that we're going to cover during this particular presentation. First of all, we're going to review the events in the financial markets in 2013. We're going to review the themes that we presented to you in this meeting just a year ago at the beginning of 2013. We're going to have a look at the United States economy, as also the global economy and Europe. We're going to have a look at our thoughts on 2014, the portfolio changes we made just very recently, and then end on a light-hearted note, dancing on the table. More on that later. So let's have a look first of all at the financial markets in 2013. What a great year for stocks. Global stocks were up nearly 23%. Who would have thought that? The most since 1997. But on the other hand, it was a terrible year for bonds. Bonds were down over 2% and had their worst year in 19 years. Of course, we shouldn't be surprised about this. We've been talking about our concern for bonds over the last 3 years. Happily, I can tell you that our portfolios all outperformed their benchmarks, and we're excited about that, and I'm sure you are as well. Let's turn to the themes we had a look at the beginning of 2013. You'll remember the title of our presentation just a year ago was Rational Optimism. Well, that turned out pretty well, didn't it? We also spoke about explosive growth in US production of oil and gas. We spoke about the game-changing effect we believe that would have on the US economy. We mentioned to you that we were particularly excited about the technology sector, and the holding that we hold there, which is the T. Rowe Price Global Technology Fund, was up nearly 40% last year. Incredible return. You'll also remember that we said we were going to have a specific holding in the banking sector, and there we held the John Hancock Regional Bank Fund, and that was up nearly 39%, also a stellar performance and contributed very well to our portfolios. We spoke about a niche opportunity in small company European stocks, and during the course of the year, we invested in the Goldman Sachs fund, which focuses on small cap funds. And that was up 33% during the course of the year, also a great contributor to our client portfolios. Then, on a more somber note a year ago, we spoke about our real concern for investment-grade bonds. And many of you hold a sizable portion of bonds in your portfolio. We expressed incredible concern about bonds. And you'll remember we introduced the terminology of volatility dampers, meaning investments that are held in the bond side of your portfolio that are not necessarily bonds, but will dampen the effect of market volatility, and so called volatility dampers. Then another major focus of and theme of our presentation to you a year ago, which is at the core and remains at the core of our DNA in terms of investments, is winning by not losing. Meaning, more correctly, we win over the long term by losing less when the market goes down. And in that context, we introduced to you the terminology, the insulated portfolio, which is a name that we have had registered for ourselves. And that is part of the core theme of our thinking, is running portfolios that are insulated somewhat against the really negative effects of the market. So those were our themes a year ago, and a number of them have come to pass and continue to work their way out during this year, we believe. So we made a number of portfolio changes during 2013. In the early part of the year, you'll remember we began the year, we were holding 2 PIMCO emerging markets bond funds, and we decided to consolidate that into one new PIMCO emerging markets bond fund, which we invested in the early part of last year. More on that a little later. And then we sold the Deutsche Bank note that we had invested in 2011. It had not done all that we had expected it to do, was underperforming, and so we decided to sell that. And we took the proceeds of that note, which were about 5% of your portfolio, and invested some in the new Goldman Sachs Small Companies Stock Fund that I spoke about earlier. And then part of it we invested to increase your allocation into the banking sector, which was a great move because banks did really, really well last year, as also did the Goldman Sachs Fund. Towards the end of the year, we made another move, which was to sell the PIMCO Total Return Bond Fund, and we were holding the exchange-traded fund version of that with the symbol BOND. And we sold it because it had really not been doing at all well, and we used the proceeds of that to buy a third Royal Bank of Canada note. You already held 2 that we had bought in 2012, and which will mature in 2014. The new note, which is a third note, is positioned in the volatility damper or bond portion of your portfolio. And it's designed to capture all of the return of the S&P 500. It is a 5-year note, so it will mature in 2018, and it'll capture all of the return of the S&P 500 between the time we bought it at the end of 2013 and when it matures 5 years later. Further, it will be protected from the first 47.5% drop in the S&P 500. So an incredible volatility damper, especially in a time when we see bonds not doing all that well and the stock market expected to do decently. And so we believe this is going to be a great addition to our client portfolios. There were a number of headline topics that made their way and shouted at us in the media during 2013. We may almost have forgotten about it by now, but we began 2013 with the words fiscal cliff yelling at us from every source of news we would turn on. And we know that eventually the fiscal cliff did not take place. Congress eventually came to its senses and did something to avoid all of that. Then we had the terminology where government didn't come to its senses, unfortunately. That was the topic on the government shutdown. That did happen. However, I'm happy to say that it didn't have all the dire consequences for the US economy that had been predicted. And then thirdly, a very important topic, tapering, which speaks about the Federal Reserve actions. The Federal Reserve has been printing money at an unprecedented rate to stimulate the US economy at the rate of $85 billion or over $1 trillion a year. And talk began to emerge during the summer of 2013 that they were about to cut that back. That sent the markets into a little bit of a tailspin for a while. And then the markets recovered. And then eventually in December, at their final meeting, the Federal Reserve decided to begin actually tapering, cutting back from 85 billion to 75 billion a month. And we expect to see more of that during 2014. As you will see from the following chart of the S&P 500, the S&P 500 soldiered on through all of those terrifying headlines and ended on the very last day of the year at its highest level ever in history. So that was 2013. So let's turn our attention to 2014. I'm happy to tell you that our theme of rational optimism from a year ago is one that would still happily apply to 2014 and beyond. We expect the United States economy to grow and its growth to accelerate during 2014. We track a ton of economic data that comes across our desk day after day after day. And I want to just share a sampling of that with you today. I don't want to bore you with too much detail, but maybe 3 or 4 points that might help you see some of the encouraging things that we are seeing. First of all, and something that I don't think will be news to you, is that the unemployment picture is improving constantly. We ended up at the end of last year at an unemployment level of 7%, which is the lowest since the Great Recession of 2008 and 2009. Of course, we all know that's still too high, and especially if we think of individuals that are still unemployed, that's not a small thing to consider. However, we do believe that the trend of unemployment will continue to improve. And as you can see from this chart, if we have a look at this chart, especially the blue line on this chart, you will see how unemployment has risen from the depths. That is, employment has risen from the depths of 2009 all the way to the end of last year. And we expect employment to improve ongoing during the course of 2014. In a kind of weird way, the markets get a little bit nervous actually about employment improving, because that alerts us to the fact that the Federal Reserve may start cutting back on all of that quantitative easing, because what they're looking at, one of the major numbers they're looking at, is unemployment. But we believe they won't be in any rush to cut back on that quantitative easing, and will do so at a measured pace. So employment is rising, and that's encouraging. Remember that that consumers are almost 70% of the US economy, and so improving employment is incredibly important for the US economy. Here's something that is somewhat of a surprise to most people, because we hear so many negative things about the US federal budget deficit. Of course, it's still too high, but here's a really interesting factor to have a look at. For the year 2013, the federal budget deficit ended at just over $600 billion. That was down from over $1 trillion at the end of 2012. That's an incredible decrease of almost 40% in the federal budget deficit. Here's another interesting element to that. That federal budget deficit, expressed as a percentage of a measure of the US economy, which is gross domestic product, is at 3.7%. That's the lowest level since 2008. So we're really going in the right direction in that regard as well. One of the indexes that we follow is what's called the Leading Economic Index. It's made up of 10 indicators that are leading indicators that point to where the economy is going. That rose the strongest during the 12 months of 2013 since 2008. So the strongest rise in 2013 since 2008. And all of this points to the fact that we have accelerating economic activity going on in the US economy over the next 12 months. We all know that inflation is low right now. Interest rates are low. That's great for the economy, and is typically great for the US stock market and for stock markets generally. Then housing prices. You'll remember at the beginning of 2012, we began to thump the table and say how cheap residential real estate was at that time, and we encouraged you to take every advantage you could of that particular fact. That was way before it became popular news that the residential real estate values were rising. Well, I can happily report that during 2013, residential real estate across the United States rose on average 13.6%. That is the highest or most since 2006, just before the collapse in the US residential market. And those prices are projected to rise a further 5% during 2014. I can't tell you how much that means for the US economy, but it has a major contributor to the United States economy. And so you can see from this next chart just how we see the movement in United States housing prices, and we believe we'll see that trend as an ongoing trend. Let's talk a little bit about the global economy and Europe. During 2013, I'm happy to tell you that the global economy continued to heal, and that's a positive for stocks generally around the world. I'm also happy to say that Europe emerged from a long and painful recession during 2013. Lynn and I were in Europe during the summer of 2013, and we could certainly see signs of an economy that was beginning to recover. According to Ned Davis research, and what we will see from this next chart, the Global Manufacturing Purchasing Managers Index, or PMI, climbed in December to the fastest growth since 2011. This index measures growth in economic production or manufacturing across the world. And we can see from this chart how it recently reached a high. We believe that in itself points to economic growth across the world and therefore a positive for stocks globally. So this is what you've been waiting for, is to hear our thoughts on 2014. We've talked about general big picture. What are our specific thoughts in 2014? Well, I'm happy to tell you that we expect the stock market to be higher at the end of 2014 than it was at the end of 2013. We in fact expect it to be in the region of 8 to 10% higher than at the end of 2013, and there's a possibility it could even be up more than that. There's been concern that stocks may be overvalued, or that price to earnings ratio, which is a commonly used measure for valuing stocks, may have got too high. And that concern is based on investors seeing that stocks have just gone up steadily for so long now. The fact is that in accordance with our research, we don't believe that stocks are overvalued. We believe that at worst they are fairly valued, meaning that they are neither overvalued nor undervalued. Jeremy Siegel, the author of Stocks for the Long Run and well-known professor at Wharton Business School, says he believes that as he looks at price to earnings ratio as a measure of stock market values, that they may well be 10% below the historic average since World War II. And so we do not believe that stocks are overvalued at this time. However, I have to tell you that we are expecting some correction during 2014, and that most likely will happen during the summer of 2014. Stocks have risen strongly during the last few years, and that creates in people's mind a concern that they've risen too long and that some correction must be on the horizon. So even just some little event can often be enough to send stocks into a tailspin. We expect that that's possible during the summer, in fact, in the early summer of 2014. So what I would say about 2014 is we're going up, but put on your seatbelts, because it might be a little bit of a rougher ride than it was in 2013. We do expect bond yields to continue to rise, which, as you know, and what we've said before, that's not good for bonds, because bond values move in the opposite direction of bond yields. And so if bond yields are going to rise, that means bond values are going to drop again. And we believe that we may well have another year in which investment-grade bonds lose money in 2014. We expect inflation to be low in 2014, but we do expect it to rise somewhat. And as we've said earlier on, we expect US economic growth to accelerate in 2014, but especially in the second half. There's going to be an ongoing massive oil and natural gas production in the United States. We believe that's going to lead to energy independence in the United States, and we also believe it's going to be a major contributor, an ongoing game changer for the United States economy. So we made a number of changes to your portfolios right at the opening of 2014. First of all, we sold the PIMCO Emerging Markets Bond Fund. Emerging markets just generally as an asset class really didn't have a great year in 2013, and especially emerging markets bonds. And the PIMCO Emerging Markets Bond Fund had a horrible year. So we've sold that, and we have replaced that with the BlackRock Strategic Income Fund. This particular fund is a multi-sector bond fund, go anywhere bond fund, but it is a very conservative bond fund and has not much more risk than a regular investment grade bond fund. However, just because of its flexibility, we believe that it certainly won't lose money on the bond side or volatility damper side of our client portfolios. On the stock side of our client portfolios, we sold the ProShares 20-plus year short treasury that we held, the symbol TBF, and we held that since 2012. We had thought that that would do pretty well in a rising interest rate environment, and we held it in the stock portion of your portfolio. While it rose, it didn't rise as well as the stock market, and so we have sold that, and we have taken the proceeds and invested them in a fund called the Gotham Absolute Return Fund. The symbol is GARIX. And it is managed by the author of this book, Joel Greenblatt. And the title of this book is The Little Book That Still Beats the Market. It is a New York Times bestseller, and for good reason. It has been that well known all the way since the early part of the 2000s. Joel Greenblatt has run a hedge fund for many, many, many years, very successfully, for ultra-high net worth clients. And for the first time a year ago, his investment strategy as contained in that hedge fund became available in the form of this mutual fund. It is a long-short fund, meaning that it makes money going up on those shares that are held long, and it makes money going down on those stocks that are held short. So this fits very perfectly into our strategy, which is to gain pretty much all of the up in the stock market while losing less whenever the market goes down. And I believe that this fund will do this. We believe this is going to be a core holding in our client portfolios, and our plan is for it to be a long-term hold, and we trust that you're going to be happy with it. We also sold a fund called the First Eagle Overseas Fund. Some of you have held this for many years, and many years ago it was a great fund, but in recent history has not done at all well. And during 2013, its poor track record continued. It was up only half what the rest of the stock market was, and we felt it was no longer earning its place in our client portfolios, and so we've decided to sell it. And we've replaced it with the Cushing Renaissance Fund. The symbol for that is CRZZX. Cushing is a mutual fund company that focuses on energy. And this particular fund we love because they aim to invest in the stocks of companies that are going to benefit directly from this incredible increase in oil and natural gas production in the United States. We believe in that trend, they do, and this is a way to benefit from that trend. Then I want to mention about the two Royal Bank of Canada notes that I mentioned earlier in the presentation. You've owned them since 2012, March the 31st, and they will mature. They were 2-year notes. They will mature on April the 2nd this year. One was held 5% each. One was held in the bond side of your portfolio, and the other was held in the stock side of your portfolio. Both of them will mature on April the 2nd. And our goal at this stage, our thinking, is that as they mature, we are going to leave the proceeds in cash in view of our concern that there may well be a correction over the summer. Of course, we will review our thinking on an ongoing basis in that regard, but If we were to do that, and there was in fact a correction during the summer, of course that would be wonderful, would provide an opportunity for us to take that cash and invest it after the market had dropped. And we know at this stage exactly where we want to put it and what will really benefit out of any market drop at that particular point in time. So we plan to hold those investments through to maturity. Then I'm going to end on a light note today, which is dancing on the table. You'll remember, related to one of those Royal Bank of Canada notes, that it was held in the bond portion of your portfolio. And it was designed to capture, from the time we took it out to maturity on April the 2nd, all of the return of the S&P 500 during those 2 years. It also was designed to protect you from the first 20% drop in the S&P 500 during those 2 years. But the price you paid for that protection was to be capped out at a 17% return on the upside. I said to you at the time, just a year ago, that I didn't see that as a negative. In fact, even if we were capped out at a full 17% return, I would dance on the table, because that would be a much better return than the basically zero you would have got out of investment grade bonds during that time. I can tell you that the market is way more than 17% up right now, and by the time this matures, I'm confident we're going to earn our 17%. So I just want you to picture, as we come to the end of this video, me standing on the boardroom table and I'm dancing over that incredible return in the bond portion of your portfolio. It's been wonderful meeting with you like this, and I trust you found it useful. I look forward to our meeting in a few weeks' time, and I invite you to bring questions with you related to this presentation, which I trust that you found helpful. And let me end off by saying I'm wishing you a wonderful 2014, and especially your portfolios. Thank you.